when we now get ready to look at the direct method, the investing and financing, we're not even going to do them because they're going to be the same. The only thing that's going to be different is our investing, our operating activities. So while we're still in the flow, let's just jump right into the direct method, and hopefully it won't take us too long because it's only one section. I'm going to pull back up my notes to kind of give us just a baseline of what we're going to do with the direct method. You can see it's not very long. We're going to have the same sections, only the operating is different. Okay, so what we're going to do is instead of starting with net income, we're actually going to take each income statement item, each expense or revenue, and then explain that with the balance sheet. We're kind of just working backwards in a way. Instead of just starting with our net income and then going to the balance sheet and look at all the differences, we're going to look at each individual income statement item and then compare that to its corresponding balance sheet item that would typically go with it. Like revenue goes with anything in AR. Cost of goods sold would go with anything in inventory. Any changes in inventory are going to be affected by that, with that. So when we have receipts from customers, we're gonna look at sales and put that with AR. And then we're gonna go to our cost of goods sold, and we're gonna combine that, and it's gonna tell us in the book, did I buy our inventory on account? Is that what mainly our accounts payable is about, buying inventory? And if so, we're gonna combine AP and inventory changes with our cost of goods sold. And it's gonna tell us then if we have any other expenses, what they go with, and with the book, it's going to be prepaid and wages payable. We're not going to, anytime we have any depreciation, that doesn't involve cash, so we just ignore that, or any gain or losses, we ignore it on the income statement because we're not dealing with net income. We're not dealing with the final number, so we don't have to adjust it out. Then we're going to look at the income tax expense, and then how much did we pay compared with the income tax payable. And then when we're all done and we add up the direct method, it should be the same as the indirect method. So the indirect method here was 108. Hopefully we'll get that with the direct method. Okay, so let's try the direct method using the exact same items we were using, except we're going to be using some of this up here. So I'm going to undo the items we're going to look at, and then we'll cross them back out as we go through. So let's put no fill. Right. So these are part of the operating. These are the ones we're going to be going back and revisiting. Okay, so the first thing we do when we're doing the operating, but the direct method, we don't start with net income. We just go right into revenue. And we see that revenue is $400,000. But like my notes said, I have to then compare to, did I get more money or lose money in AR? So when I compare then this, and then I go back up, so my revenue of 400,000, and I go up to my AR says I actually collected more than 400,000 because my AR went down. I collected an extra 11,000 on top of the 400,000. So I can, let's knock this out. And I come over here, cash receipts from customers. This includes the 400,000 in sales plus the additional AR that came in. If the AR would have went the other way, if the AR would have been up in 2017 compared to 2016, then we would have subtracted the amount of difference. Okay, so we can mark out revenue. We're ready to look at cost of goods sold. 210. 210, we spent money for our merchandise. And then it tells us down here in our problem, this is where the direct notes come in. Inventory is the only account that uses the account payable. So we're going to look at cost of goods sold. We're going to look at inventory and accounts payable. So when I come down here to cash payments for inventory, I start with the 210 because I paid for that cost of goods sold. And then my inventory went, or let's start with AP. My AP went down by 10 grand. So that means I paid money. I paid off on some of my account payable from prior times. So I need to show that I paid money, an extra -10. But then to kind of counterbalance that in this one particular case, my inventory went down. So therefore I kind of saved money because I didn't replace some of the inventory. So think of cash as going back up by 10. So when those two cancel each other out, we're just left with the regular 210. It's usually not necessarily just going to be the same. These are not going to always cancel each other out. It just happened to in this problem. So I have now put these two numbers into my statement of cash flows. You can mark out my cost of goods sold. Wages expense. Well, we're going to compare that with our wages payable, obviously. Wages expense says 20,000. My wages payable says I didn't quite pay all 20,000. I put an extra 1,000 on account. So when I come down here, my payments for wages is going to be the 20, but that 1,000 that I have saved temporarily. So it's really that I only paid 19 as cash payment for wages. So I'm going to cancel out my wages and my wage expense. Interest. I come up to my balance sheet. I don't have any interest items that are payable. So whatever I have here as an expense, that's how much I actually paid. That one is really easy. Cash payment for interest, 7,000. So we can mark out the interest expense. Remember, we can skip right on through depreciation. That never affects cash, and we don't need to adjust for it in any way. Other operating expenses. I tell us in the notes that other operating expenses includes prepaids. So we're going to deal with the prepaid item with this one. So we had 15,000 of payment in other operating. So I have the 15,000 here as a minus because it's a payment. And then I came up to my prepaids. My prepaids went up by 2,000. So that means I spent extra money. So if I spent the money, then I need to show that I have another 2,000 being sent out. So another negative 2,000. So I spent 17,000. I've now taken care of all of those balance sheet items. And I'm almost done with this. My loss, I just don't need to put that on there. Just like with depreciation, I don't need to readjust for it. The only thing I have left is my income tax, 50,000. I don't have any income tax payable. So whatever it is, I paid it all off right now. So I'm going to put cash payment for income tax, 50 grand. That takes this away. Now I'm ready to add it up. And when you add all of these together, you should get that number that we had before, 108,000 as cash provided from operating activities. So that is how we go about, and that's the only difference from the direct to the indirect. You would still do the investing and the financing, but they're going to look just the same as the indirect method did. This is the only thing that's going to change, the only section. And you can see how it's just different. It's just looking at the income statement item by item instead of the balance sheet more item by item, the indirect method did.